Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, July 29th. I appreciate you tuning in today and for coming by to watch another edition of my Weekend Review podcast. In this podcast, the format is as follows. First of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, both on the daily time frame, the weekly time frame, and the monthly time frame. So I'm going to talk about why I entered the trade, or when I entered the trade, why I entered the trade, and most importantly, how I am going to manage the trade going forward, whether it's going my way or if it's going against me as well. So had some good trades this week. Happy and excited to show you those. And I hope this podcast is going to give you an idea of how I look at trading, how I look at rejection of certain levels, how I position size correctly based upon the market's current volatility, meaning how many shares I'm going to buy based upon my total trading account, how I'm going to set end of day stops, how I'm going to set emergency stops, how I'm going to take partial profits to the upside if I'm correct. If I get to a certain level above my entry, then I'll go into trailing stop mode. So basically, I'll just show you the process that I use of good trading principles, which is position sizing correctly, looking for a important level of rejection, using that level as your line in the sand. Doesn't mean you're going to be right, but if you're right and you do things correctly, then hopefully you're wrong small. I'm sorry, if you're wrong small, and if you're right, you can be right big. That is the math, that is the calculus in trading. Good risk to reward ratios centered on good, strong levels of support if you're long, and if you are short, strong levels of resistance. So we'll go through, take a look at all the trades, when I bought them, why I bought them, and how I am going to manage them going forward. After that, I'm going to do a little bit on trader psychology. Always the most important skill in trading is just the skill of being patient, waiting for the correct entry, and also the skill of having discipline, of getting out quickly when you are wrong, staying in when you are right. That's, a lot of people want to take profits quickly and hold on to their losses for a long time. That's exactly the wrong thing. You need to be very impatient with your losses and very patient with your winners. So hopefully by going over these the trades and then talking a little bit about trader psychology, you'll understand how important sticking to your process is. And trader psychology is all about sticking to your process. There's lots of different ways to trade, a lot of different approaches, but they all have to do with good risk to reward ratios. So anyway, hopefully that's going to be helpful for you. It's always helpful for me to teach trading psychology, and so I hope it's helpful for you, and it resonates with you when I talk about it. After that, I have gone down through my master watch list, both on the daily and the weekly charts. And I have identified some potential trades that I'll take next week. Now, the markets that I'm gonna go over are not at the levels they need to be yet. What I do is I look at a chart, I look for those confluences, those combination of levels that could happen next week, whether to the upside or to the downside. And if they get there, then I'll consider taking the trade. If they don't get there, I'll just move on to another market. So I have identified some longs and some shorts, both on the daily and the weekly trades, and hopefully this is helpful for you. All right. So first of all, let me run this U.S. legal disclaimer, get that out of the way, and I will be back in about 40 seconds. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right. Thanks for holding through that with me, and let's get started. And by the way, when I show you these trades, I'll express to you what I'm looking for the rules associated. I trade 5 different trading approaches. They all have different rules. And if you're new to this channel, you might think, boy, those are a lot of rules. I'm not sure I'd ever remember those. But I do want to mention, and I'll mention it again at the end of the podcast, but I want to mention it right up front. I do teach private one-on-one lessons in the evening time via Skype. I love to teach. I teach a great course where I teach you step by step all 5 of the different trading approaches that I use. The course is 15 hours long. So it's a long course. It's very detailed. And like I said, I teach you all of the approaches that I use and all of the rules. I've taught many people, many people over the last 4 years from all over the world, both from absolute beginners all the way up to seasoned hedge fund managers. So if you're interested in learning the skill of trading, I'm a great teacher. I've gotten so many great reviews from my students. I'm fully booked up at the moment. But reach out to me. My email's in the link in the description, and we can organize something for us to speak about setting up a time in the future. All right, so let's get started. All right, new trade on the dailies that I took on Zions Bank, ticker symbol ZION. Now, I did short this on Friday here at 38.80. Currently, we're 38.69. Why did I short this position? Well, on Thursday, you see how we came up to the 200-day and rejected it? Now, that by itself is a legitimate short, especially in the context of we have a RSI divergence. RSI divergence, take a look at the high we have here. See how high the RSI reading was? Well, now on Thursday we got even higher, but do you see how the RSI reading is not as high as it was back here on the 20th? That's showing that we are running out of buyers. Also, back on the 20th, we were above the 6th ATR channel. Now we are higher than we were back on the 20th, and we are only at the 4th ATR channel. So we have an RSI divergence, we have an ATR divergence, we had a rejection of the 200-day moving average on Thursday, which means we tried to get above it. There were no more buyers up there. We moved back down along with the V1 entry. I did not short it here, and the reason I didn't short it here was it's a little extended to the downside away from the 200. I wanted to wait for a better risk to reward ratio, and we did get the rally on Friday. So I'm shorting at a higher level than I would have on Thursday, which is good because if I took the trade on Thursday, I'd be down on the trade. And I have a very good risk to reward ratio on the 200-day moving average. So I got short here at 38.80. My end of day stop, now remember I used 2 stops. My end of day stop is simply going to be a close above the 200-day moving average. If it closes above the 200-day moving average, I am just out of the trade. If I'm right, and it continues down, I will take partial profits as it moves down. If it moves down the value of 0.45 ATRs from my entry, I will take partial profits, not all, but 10% profit. I'll take 10% of the position off, lock that in as it continues to move down. I will continue to lock in profits because what that does is that reduces my overall risk because I'm reducing my position size. So RSI divergence, ATR divergence, rejection of the 200. Also, look at the volume on Thursday on the down move. It was quite substantial. Yes, we rallied on Friday, but look at the week. I mean, this is the lowest volume I can see in the recent past on the way up. So that also tells me something as well. Now, I talk about position sizing, and this is very important. And this is a great formula that you can position size based upon the volatility, whether you're long, short, regardless of how much money you have in your account. But it is based upon how much money you have in your account. So let's just use a hypothetical $100,000 account. If I have a $100,000 account, I take 1% of that, which is $1,000. If you have a $50,000 trading account, your maximum allowed loss would be 500. If you had $1 million, it would be 10,000, right? So let's just use the hypothetical. Take 1% of that. It's 1%. I divide it by the value of the 2 ATR. Currently, the value of the 2 ATR is 371. So $1,000 divided by 371 tells me to short 269.5 shares, so I'll just round that up to 270 shares. Now, my end of day stop is simply a close above 200, but I have to have an emergency stop as well, and the emergency stop is always 2 ATRs above your entry. So if I have 270 shares and it moves up 3.71 to my emergency stop here, then I've lost $1,000. Now that only happens about 5% of the time that you'll hit that emergency stop. 95% of the time, you'll just have a smaller loss of a close above the 200. Now, I wait for the end of the day. I wait for the closing prices to make my decision, except for if I hit my emergency stop. So Monday, if we rally up even intraday and we touch that emergency stop level, what do? I get out, right? Because I've hit my maximum allowed loss. And how much will I have lost? $1,000. So it's nice to know that you know exactly how much you are going to lose. 99.9% of the time. Yes, it could gap over that. I'm aware of that, and that does happen, but very, very infrequently. That's why I place it 2 ATRs above, because that's 2 standard deviations above where I entered. Very unlikely that's going to happen. So 95% chance that if I'm wrong, I'll be wrong somewhere with a close above the 200-day moving average. If I hit my emergency stop, then I'm out, most likely with a maximum loss of $1,000. Yes, it could gap above. Very unlikely that would happen, and that's just part of the risk of trading. So we always talk about risk first. So that's how I position size, whether to the upside or to the downside. So again, RSI divergence, ATR divergence. Thursday, we rejected the 200 already. Now we rallied back up, giving me a better risk to reward ratio, also very low volume. So I really like the trade. I really like this trade. Doesn't mean it's going to work, but if it does work, great. If not, I position size correctly. I know what my maximum allowed loss is. And if it just simply closes above the 200, I will just simply get out of the trade. So a little bit in the money here by about 11 cents so far. VIX. Don't have a lot of trades on the dailies. Okay, I got long the VIX back on the 19th of July. Why did I buy this? This is a deep dip buy. We went under 30 RSI and over 30 RSI, and we have a V1 entry trigger. And if you don't know what V1 and V2 entry triggers are, they're a big part of my trading. You can go to my YouTube channel in the lessons playlist. I have a great video there on V1, V2 entries. They're great entry signals. They don't always work. Obviously, this trade was a losing trade, but they work a lot more than they don't work. So do yourself a favor, watch that free video on YouTube. I think you'll learn a lot and be glad that you watched it. So the entry trigger was here on the 19th. The confluence of signals was an under 30, over 30, and also a V1 and a bullish engulfing bar, by the way. Got long at 23.80. The main reason I took the trade was the under 30, over 30. Therefore, in the future, if we close below 30, I would just get out. Orange line up here is my trailing stop level. If I had gotten there, then I would get into trailing stop level, which means that once I'm in trailing stop level, in the future, then if I have a close below a previous bar's low, I will get out of half. So anyway, that did not happen. I got long at 23.80. Next day did go up for a moment, but VIX was just too weak. And then here on the 24th of July, it did close back below the 30 RSI. So I had to get out for a loss of 2.14%. All right, so that is it on the dailies. Let's go to the weeklies. A lot of weeklies and monthly trades. All right, IWM. This has been a very long-term trade for me. I did buy IWM way back at the lows of the market back on the 14th of October in 2022. Why did I get long here? I got long here on the weekly bars, which close on Friday, with the rejection of the 300 week moving average. This is the orange line. During the week, we went below the 300 and then closed back above it. I got long at 169.19. I position size. I placed my emergency stop 2 ATRs below, so I knew what my maximum allowed loss was. And then my end of week stop on this would simply be a close below the 300 week moving average. Now, to the upside, I place my trailing stop level 1.5 ATRs above my entry. So if we get to that point, and we did, then if I get a close below a previous bar's low, I would get out. In addition to that, as I mentioned, if it moves the value of 0.45 ATRs for my entry, I take partial profit. So I got long here at 167.19. Next bar went up significantly, took some more profits. Next bar went up again, took some more profits on the table, locked those in. Next bar didn't go up enough for me to get a profit target. Next bar had a huge rally, took more profits off the table, and also got to trailing stop levels. So now, if I get a close below a previous bar's low, I will get out of half of the remaining shares. This happened here on the 9th of December. Sold half the remaining shares for a profit of 6.51%. Then we moved down, no profit targets, and we had a huge another rally moving up where I took more profits here, I took more profits here, kept reducing my position size, locking in the profits. Then we had this huge move down. I was thinking, okay, we're going to close below the 300-week moving average. We never did. We tested it here, we tested it here, we tested it here, we tested it here. Did not want to close under this 300, so it kept me in the trade. And then, of course, over the last few months, I've had a huge move up where I've taken more profits, more profits, more profits, more profits, more profits. And the remaining shares that I have on this particular trade up significantly, up 14.86%. Now, we're getting to an important level here, and this is what I was talking about the rules. We are at 6261 RSI. If in the future, if we get above the 65 RSI, then this 5 EMA will come into effect. So if we get to a 65 RSI level, which we're very close, if it ever gets to that 65 RSI level, then I start instituting this 5 EMA. I don't want this to let this come all the way back to the 300. So again, all part of the rules. The different trading strategies have different rules. And again, that's what I teach in my one-on-one lesson. But the remaining shares I have on IWM doing very well, up 14.86%. XLF. All right, I bought XLF all the way back here on the 24th of March at 30.71. Why did I buy? Well, we rejected the 250-week moving average. I saw that the price did not want to go below this and rallied back above it. I got long here, 30.71. I position sized. I placed my emergency stop 2 ATRs below, so I knew where my maximum allowed loss would be. I placed my 1.5 ATR trailing stop level above, so that when I get, if and when we get there, I go into trailing stop mode. And again, I take partial profits on the way up. To the downside, if we simply close below the 250, I would simply get out for hopefully a small loss. So next bar moved up, I hit a profit target. Here to here, I hit another profit target. Kept taking shares off, locking those in, reducing my position size. Got to trailing stop level. Then we came back down. Never closed below a previous bar's low. Moved back up here, took some more profit targets here on the 23rd of June, had a close below the previous bar's low, locked in half the position for 6.40%. We moved up again, took more profits, moved up again, took more profits. 2 weeks ago, took more profits, right? Continuing to reduce my position size. And the remaining shares that I have on XLF, up 12.71%. Look at this risk to reward ratio that I had on this trade. If I would have been wrong, maybe I was wrong a couple percent, right? Maybe 3%. But now here, up 12.71% on the remaining shares. This is what profitable trading looks like. Looking for a level that gets rejected, position sizing correctly, placing your emergency stop, end-of-day stop, taking partial profits on the way up, getting to a certain level, looking for trailing stop level. This is exactly what I did. And, you know, if you would have read the news back here, everyone, it was very bearish. It was very gloomy. But the technicals, that's why you should follow technicals, and that's why I follow technicals, instead of what's going on in the news. Right here, there was nothing positive in the news that would have scared you from taking the trade. But what I took the trade because of the technicals that did reject. The market doesn't lie. What you listen to on the news, I wouldn't listen to that if I were you when it comes to investing. The market tells the true story, and the market did not want to go lower than here, and that's why I bought it. So up 12.71%. XLE, real estate. All right, this was a different approach. This is called a higher low V2 approach. Again, this is what I teach in my one-on-one course. Got long here on the 2nd of June with a higher low V2. The rules on higher low V1s or V2s is that first you have to close below the value zone. The value zone is this green line and this green line. Anywhere within here is the value zone. We closed below the value zone. We rallied into the value zone. We had a pullback, and then we created a V2. V2 consists of 3 bars, bar 1, bar 2, bar 3. Bar 2 goes below bar 1's low, closes above bar 1's close. That's the entry trigger. I got long at 36.32. You see how this low here is higher than the previous low? Anything higher low, if you're going long, is better. That goes for higher low V1s, V2s in the value zone, or even higher low under 30 over 30s, higher low rejections of the 200, 250, or 300. So I position size here, got long 36.32. Now, we don't have a 30 RSI, we don't have a 200 to key off of, so my end of day stop is simply a close below halfway of the washout bar. And in a V1 or a V2, the second bar is always the washout bar. So my emergency stop's down here, 33.07, 2 ATRs below, but my end of day stop is simply a close below halfway of the washout bar. Next bar moved up, took some profits. Next bar moved up, took some profits. Then we had a big down move. But do you see how we did not close below halfway of the washout bar? The halfway of the washout bar is important from a Fibonacci sense of 50%. If it had closed this week below here, I would have simply gotten out for a small loss. But it held, so I held the trade. Next bar, open lower, literally touched it to the penny. Pretty important, right? It literally touched it and said, nope. Rallied back up, had a very nice 2 profit targets in that week. We continued up 3 weeks ago. It got to trailing stop level, which means now, if I had a close below a previous bar's low, I would simply get out. Do you see how this week we almost closed below this low? If this had happened, I would have gotten out of half of the remaining shares after the partial profits that I took. But it did not close below, so I continued to keep the position. This particular position up, respectable 4.17%. And then last trade on the monthlies. I do trade monthly bars as well, last day of the month. And this was a great trade and a good teaching situation as well. I did buy Love Southwest Airlines back here on the 31st of May with this rejection of the 200-month moving average. And you look in the past, look way back over here. Did it respect the 200? It sure did. Here on the 31st of March, it touched it, closed back up. Next bar, went below it, closed back up. The bar that I bought it at, again, tested the levels and the prices below the 200-month moving average and closed back above. So what did I do? I position sized correctly. I placed my emergency stop 2 ATRs below. My end of month stop on this particular bar would simply have been a close below the 200-day moving average, which did not happen. The next month, huge move up. I took 2 profit targets off the table. The next month, this month, moved up again, took another 10% of my shares off the table, locked those in. And then I got out on the 27th on the remaining shares for a gain of 20.67%. Now, why did I get out? None of my technicals told me to get out. Well, I got out simply because Southwest Airlines had earnings, and I got out right before earnings. I never hold through earnings. And luckily I did, because you can see here on the daily, look, I got out here, and then we had earnings, and look what happened. Boom. So in my opinion, it's not a good idea to hold through earnings. Yes, of course, it's a quick way to make a lot of money, but it's also a quick way to lose a lot of money. Southwest Airlines was down to about 10%, so I'd have given back half of my profits. So out of this trade here, it was a great 2-month trade for a profit of 20.67% on the remaining shares. All right, so just a quick recap to go over these. Zions on the daily. Just took that trade on Friday. In the money a little bit. I haven't even done the percentage here, but basically break even at the time. Just took the trade, so I am short Zions. VIX on the weekly, I did get out for a loss, or on the daily, I did get out for a loss of 2.1%. On the weeklies, IWM remaining shares up 14.86%. XLF remaining shares up 12.71%. XLRE remaining shares up 4.1%. And then Love on the monthly was a gain of 20.67%. So you can see from all the trades, they're not all winners, but the winners are larger than the losers significantly. And that's what's important in trading. You're going to have losers, but the key is to keep those losers small and have a process that lets you keep your winners so you can get those larger gains to offset the inevitable losses that you're going to have. And again, that's what I teach in my one-on-one course. You should consider taking it. I love to teach, and I really like to help people with their trading so they can learn these proper trading techniques and principles. All right, let's do a little bit on trader psychology. This is from Trading Composure over on Twitter, or I guess they call it X now. That's going to take me a while to make that transition. But please follow Trading Composure at Trading Composure over on Twitter or X. Great channel. Deals a lot with trading psychology. Really respect this channel. And let's see what they have to say. We project our own experiences and understanding onto the market. Therefore, our equity curve tells us more about us than it tells about our trading system in the market. Now think about this. What are they saying? If the market's up and you're down, it's telling you more about how you're viewing the market. You're saying, oh, I don't think this market can go up, and there's all this bad news, right? Where the technicals of the market are telling you that it's going up. If the market's going down, and your if your equity curve is going down and the market's going down, that's telling you that you're bullish while the market is bearish and that you're not in phase with the market. The whole concept here that I'm trying to relay to you is follow your technicals. If the market's going up, the technicals will tell you that things are bullish. If the market is going down, the technicals will tell you that they are bearish. Don't fight the market. Use the technicals. The technicals don't lie. If things are bullish, they'll reflect in the chart. If they're bearish, it will also reject. They'll also be in the chart, right? So one more time, we project our own experiences and understanding onto the market, or our biases. It's probably another good word we could put in there. Therefore, our equity curve tells us more about ourselves and our thinking than it tells us about our trading systems or the market. So thank you for that, Trading Composure. Please follow Trading Composure at Trading Composure over on Twitter. All right, let's get to potential trades for next week. These are on the daily, by the way. And again, these markets are not going to be at the levels that I'm looking for. You have to be patient and wait for the market to get to the level that you're looking for. And for me, when I look at GDX, gold miners, the 200 sticks out like a sore thumb. Look, did it respect the 200 last time? Little close over, close under, close over. Yes, respected it, failed, and then it closed back over. An ability for a nice trade. It doesn't mean that if we come to the 200 that it's going to hold it, but it is a good level to key off of. So GDX next week, if and only if we come down, either have a close under the 200, then back over the 200, or an intraday rejection of the 200, or a bounce at the 200, I will consider getting long GDX. And if it closes, let's just say Monday, it goes underneath it, then closes nice and gradually back over it, then it gives me a good risk to reward ratio. The 200 is my line in the sand. And if it does that, I'll position size by taking 1% of my total capital, dividing it by the value of the 2 ATR. That tells me how many shares to buy. The 2 ATR also shows me how far below my entry is my emergency stop. If in the future, then, if I take the trade, if it closes under the 200-day moving average, I simply get out, hopefully for a small loss. If when I enter, if I will place my 1.5 ATR trailing stop level above. If it gets there, then I go into trailing stop mode, which means if I have a close below previous bar's low, I will get out of half. If it never closes below, I'll continue to stay with it. As always, as it moves up the value of 0.45 ATRs from the previous bar's close, I will take partial profits, 10% of the remaining shares that I have. And then if we get up to 65 RSI level, then the 5 EMA will come into play. A close below that, I'll get out of everything. If we reject the 70 RSI, I will get out of half. If after rejecting the 70 RSI, if we have closed below previous bar's low, I'll get out of the whole trade. And I know that sounds like a word salad. I know it sounds complicated, but it's really not. I've been teaching a lot lately, last week, and this is exactly what I go over with my students, and they picked it up the first lesson. I know on this podcast it probably sounds difficult, but we do so many simulation trades. We just go over so many trade after trade after trade using these rules. So you will understand it once if you take my course. You will understand this like you'll know it like the back of your hand. All right, but it all comes down to risk to reward at a level. And when I look at GDX, I clearly see the 200 as the support level. If it gets there, I'll consider taking the trade. If it just takes off from here, then great. I'll just forget about it. CarMax. All right. One of my favorite approaches is called return to value V1s, V2s. Now, the two green lines here are the value zone. Anywhere inside of the green lines is called the value zone. You want to buy in value, sell above value. You want to buy below value, sell in value. What most people do is they buy way up here, way above the value zone. Why? Well, the news is good, the headlines are good, it gets people to have FOMO. You really have to fight the urge to buy above the value zone. Wait for it to come back into the value zone and then sell above the value zone. Look, here we were above the value zone. Was that a good place to buy? No. In the value zone, was that a good place to buy? It was. Selling at above value. Well, now we've come back down into the value zone, and this is one of the approaches that I teach in my course. It's called a return to value. The rules are you have to close above the value zone. You then have to come back into the value zone. Then you have to have at least 2 bars of sideways motion to show that there's an equilibrium of buyers and sellers. That is not just continuing to go down. So this is called consolidation is price discovery. The market will at some point after moving sideways pick a direction, whether that's up or down, I don't know, but it will pick a direction. And for me to explain V1s, V2s here is a little hard just in words. So what I did was I took a picture. This is something that I use in my course. But real quick, look at CarMax, KMX. You see how we were above the value zone? See how we returned to the value zone? You see how we're going sideways, right? Well, now look at this particular chart. What is this? This is NAT, Nordic America Tanker. Look, here's the value zone, the 2 green lines. We went above the value zone. Don't want to buy up there. Came back into the value zone. Do you see the sideways motion? And then we had the V1. Bar 1, bar 2. Bar 2 goes below bar 1's lows, closes above bar 1's close. My stop would be a close below halfway of the washout bar. Never happened. And look at the resumption of the trend. You've probably heard buy dips in an uptrend, sell rips in a downtrend. Well, this is exactly what. This was a uptrend that came down, stabilized, look for a V1 or V2 entry to buy the dip, and then the resumption of the trend. Well, that's the same with CarMax. We're above the value zone. We came into the value zone. We have sideways motion. All I'm looking for now is a V1 or a V2 to trigger me into the trade. Then I'll position size, emergency stop, end of day stop will be closed below halfway of the washout bar. Okay, but again, this is what I teach in my lessons, and these particular patterns. I was just teaching one of my students on Thursday, and I said, I want you to have the right mindset about these setups. These trades do not come along very often. Yes, you can find one or two a week, but they do not come along very often. And that's why I'm highlighting this particular trade on KMX. We're above the value zone, into the value zone, beautiful sideways motion. This is showing a perfect potential setup, which doesn't mean it's going to work, even if it's perfect, but the chances are much greater that it will work. But I'm missing the trigger. I need the V1 or the V2 to trigger me into the trade, and that's why I suggest you go to my YouTube channel, watch that free video on V1 and V2 entries. So the context is set up here. It's a perfect setup. Above the value zone, into the value zone, sideways motion, just looking for a V1 or a V2 to enter me into the trade. Lockheed Martin. All right. I have been talking about Lockheed Martin for a couple weeks now, I guess, or at least a week. I am looking to buy Lockheed Martin with a rejection of the 300. Remember the nice trade on IWM that I showed you with the rejection of the 300? Well, here it is. But I still need the bar in the future anytime next week to go down below the 300 and then close slightly above. That would be an intraday rejection of the 300, or conversely a close under, close over, or a bounce. Then my line in the sand, which is this 300, is very, very close. And if I'm wrong, I can be wrong, most likely small. If I'm right, could have a nice outside gain to the upside. So again, on LMT, I'm just waiting next week for some kind of bounce, intraday rejection, or close under, close over the 300. VIX. Talked about VIX, and I did have that losing trade on VIX, but I really do like VIX. No one likes VIX. That's why I like it. But we have a lot of things going on here. We have a double bottom bullish divergence. Look at the lows here. Look how deep the MACD bars were. Then we rallied into green. Now, are we lower here than here? Obviously. But do you see how there's no red bars here? That means there's a double bottom bullish divergence. What that really means is that the down move is running out of sellers. The momentum to the downside, excuse me, is slowing. Now, Thursday, there was a legitimate trade on VIX because it went under 30, over 30. I didn't take it because the risk to reward ratio wasn't good. But now I actually consider taking this Friday because now we're at a 33 RSI. So we're still above the 30 RSI, and 33, 37 down to 30 gives you a very good risk to reward ratio. But what I'm really looking for here is another under 30, over 30 next week. If we could go under 30, over 30 next week, then we would have a higher low under 30, over 30. See, here we had an under 30, over 30, but it came from a lower low, still legitimate, by the way. But next week, if we could go under 30 and then over 30 again at a higher level than this first under 30, over 30, that would be an excellent, excellent signals. Higher low, under 30, over 30s are very high probability trades. So just to be clear and just to recap, on VIX next week, if we go under 30, over 30 again, I will take the trade. I will consider taking the trade. And then, I don't know why I have Zions Bank on there. I already took that trade. So no, so that's it. So recap. On the dailies, GDX, I would consider taking GDX if we had a intraday rejection of the 200-day moving average, a bounce of the 200-day moving average, a close under, close over the 200-day moving average, and I should use the word nice gradual close. If we came in down and bounced and then bounced up to here, then the risk to reward ratio isn't good. But if we have a nice gentle rejection of the 200 where the risk to reward is still good, I would consider taking GDX to the long side. CarMax, return to value, sideways motion, looking for a V1 or V2 entry to get long. Lockheed Martin, looking for an intraday rejection, bounce, or close under, close over the 300 SMA. And then VIX, again, another under 30, over 30, which would be a higher low under 30, over 30. Now, it's conceivable that all of these trades could trigger on the same day. Does that mean I would buy all the positions? No. I have a rule. I only take one swing trade per day, or depending on the time frame, one signal per week or one signal per month. If they all triggered on the very same day, I would only pick one. I would narrow everything down and pick the best one. Well, what would be the best one? The best one would be the one that has the best risk to reward ratio, the one that has the most confluences combination of entry signals, the one that looks best on the higher time frame, which is very important. I don't talk a lot about this here, but I do teach this at length in my lessons, looking not only for signals on the daily chart, but looking to a higher time frame like a weekly chart to see if there's some kind of confluence of indicators lining up or support on the higher time frame. So they may all look great, but looking at the confluence, looking at the signals, looking at the risk to reward ratio, looking at the higher time frame, I can narrow it down to the very best one. All right, now let's look on the weeklies. Now weeklies close on Friday, so let's take a look at the potential. Nike, you've heard me talk about Nike for several weekend podcasts in a row here. I am looking for another rejection of the 300 here. I almost took this here, but it didn't quite touch, so my rules told me I can't buy that. So next week, if Nike does come down on Friday and had rejected that 300, well, that gives me a good risk to reward and a good support of a major level like the 300. So on Nike next week, if we have an intra-week rejection and a nice gentle close above the 300, I would consider getting long Nike, or a bounce at the 300 with a nice gentle easy close above to give me a risk reward on Nike. Okay, Pfizer, PFV. All right, so now look, why can I not get rid of that? There we go. We are currently a 3787 RSI. There's a couple potentials for next week. One, that we could go under 30, over 30, or simply close above the 300-week moving average. But we do have earnings on the 1st. So I'm not going to get involved with Nike before earnings. But earnings will come out on the 1st. Let's take a look. We've got, that's Tuesday they have earnings. So I wouldn't consider making this trade until Friday the 4th. So that's all good. So on Friday the 4th, after earnings, because I don't hold through earnings, but Friday the 4th, if on that day, on that close, if earnings are bad and we go under, but we close over the 30 RSI, I would consider taking the trade there. Or conversely, if we had a nice gentle close above the 300, I would consider taking the trade there. And it's nice because then earnings are out of the way. And then last but not least, XLU, which are utility sector ETF fund. If we have a move down intra-week rejection or bounce at the 200, giving me a good risk to reward ratio, I would consider that there. And you can see it's respected the 200 in the past to a degree. Closed under, closed over, held above, closed under, closed over, held above, closed under. So it's not the best respect for the 200, but if we get a nice gentle bounce or rejection of the 200 week next week, I would consider taking this trade. Or alternatively, and probably better, if we move lower to the 200 week moving average, then I could consider getting long there as well. So real quick recap, Nike, a nice gentle intra-week rejection of the 300 or bounce at the 300, I would consider taking the trade. Pfizer, after earnings next Friday, and under 30, over 30, I would consider, or alternatively, a nice gentle close above the 300 week moving average. And then on XLU, a nice gentle close above the 200 or intra-week rejection of the 200 would be one consideration. And if we go lower, an intra-week rejection of the 250 or a bounce of the 250 would also be a good place as well. So, hey, listen, if you like this podcast, I would really appreciate it if you would hit the thumbs up button. It does help the channel. It lets YouTube know there's some valuable content here. So if you did learn something today that you thought was valuable, I would really appreciate if you could just take a couple seconds hitting the thumbs up button. At the beginning of the podcast, I did mention about the one-on-one lessons, the course that I teach. Everyone, it's a great course. I've been teaching this for years. I've taught people from all over the world. It's 15 hours. Each session is 3 hours, and then we do 5 sessions. So it's a long course, it's an intense course, and I think the best way to learn anything is to learn it one-on-one from an instructor that has a lot of experience and knows how to teach. And I do. I've been trading for 28 years. I love to teach. I'm very patient. And it's very important to me that my students succeed. So all you have to do, if you're interested in this course, the course does cost $1,750, by the way. I know it's a lot of money, but for what you get and the experience and the one-on-one, it really is worth every penny. And it's that's kind of a small price to pay to really learn a skill that you can use for the rest of your life. So my email is in the description of this YouTube video. All you have to do is send me an email, say, Greg, I'm potentially interested in taking your course. I'll reply and say, hey, great. Let's set up a Skype call. The Skype call is free. It's not a sales call. I promise you, all I want to do is learn more about you, your trading challenges, your goals, and it's a great time for you to ask me any specific questions about the course as well. And when we're done with the call, that's it. And then in the future, after the call, if you decide, hey, I want to do this with Greg, I want to learn this, just email me back, say, yep, I'm ready to go, and we'll set up a time and a date, and that will be it. Now, if you like online courses, I have a great online course available at udemy.com. I teach you in that course the deep dip buy stock trading approach. It's a great course. It's very affordable. It's only $12 to $15. I think there's 9.5 hours of video. There's 26 videos. There's 15 study guides. And it's not as good as the one-on-one course, right? Because you can't ask questions and so forth, but it is a great course, and I've sold a lot of them around the world, and I've had such good feedback from people and reviews on that course. So the link to that Deep Dip Buy course is in the description as well. Now, most importantly of all, please try to go out and do something nice for someone today. We could all make this world a better place if we could just do one nice thing for another human being. If we need help, we always appreciate someone doing something for us. So why not return the favor? Just try to do one nice thing for another human being today. If you could also go out and try to do one nice thing for an animal, I would really appreciate that. Animals appreciate acts of kindness just like we do. It's just good karma. And if you could help an animal out a day, if you can help a human out a day, it would just be a good thing. And hopefully one day someone will be there for you if you need it as well. So I appreciate you coming today. I hope it was helpful. I hope you learned some things. If you have any questions or comments, please put them in the comment section of the YouTube video. I'll do my best to reply to them. But I hope you have a great weekend, everyone. Please be careful with your trading. Please follow your rules. And God willing, next week, I'll be back and we'll go over the trades that I took this week and we'll see how they're doing. But be good, be safe, get out, get some exercise, do something nice for a human, do something nice for an animal, and also do something nice for yourself as well. All right, everyone, on the way out here, I have to run the US Legal Disclaimer, but thanks again for your time. Appreciate you investing it here, and hopefully we'll talk to you next week. Have a good trading week next week. Take care, everyone. Bye-bye.
U.S. Government Disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.